Hey everyone, so today I want to share with you 4 really good ETF holdings for a very simple and clean ETF portfolio. These are really good for a core portfolio balance, and then you could play with other ETFs as you become more experienced, especially if you are a beginner. These are very easy, simple, and clean, and they're not very, very niche. So let me go through those with you right now. So the first one that I want to show you all is QQQ, which is all technology. If anything, it's 99.99% technology. We see here that the 1 year is 18% gain. So had you left your money in QQQ at the beginning of last year, you would have made 18% more than what you put in. In the 5 year is 102%. So that's about a 20% on average gain, per year. So, and also QQ is very risky. It does have a lot of up and downs, but as you see in the 5 years, you would have made a lot of money even if there was down years. And I want to show you all some of the core holdings. You see here that 53% of QQQ is made up of these companies, major players in technology and AI. And a lot of the other ones I'm going to show you are different, but one is that they share same holdings, but there's 3,000 more holdings when you get a total stock. So by weight sector, you see it's mostly technology, communication services, healthcare, industrials, utilities, basic materials, energy, and those are the core holdings of QQQ. So next, I want to share with you all the Vanguard emerging markets. This has been doing very well the past couple of years, and it's expected to do well again, but obviously past performance is not future promises. We see here that the 1 year is 25%, and we see the 5 year is actually only 8%. So you see that. So you see the emerging markets have been trending a lot in the year, but with the 5 years, you're only talking about an 8% gain. But emerging markets, given political climate and broader news, they're expected to do well again this year. And also, this is for less risk. You see how it was less growth, 8%, but that also means there's less risk involved, like QQQ. So you see here we have semiconductors and Alibaba. So you see here there's some Chinese and Taiwan holdings. These are going to be the emerging markets. So all of it is primarily going to be foreign entities and their businesses. Especially in today's climate where we're becoming more global, these companies are expected to do well, and this is a good pairing for less risk with QQQ. Then you also want to have a dividend portfolio. This one is probably one of the better ones. This one is highly rated. A lot of people enjoy this one. There's so many, so you can choose a dividend. Just compare it. Go to an ETF comparison website, and I can make a video later, and we could do a chart where it tracks both, and you'll see how close they are. And if they're close or not close, that'll depend on what dividend portfolio and ETF you want to choose. Obviously, you're going to want the one that pays more dividends and that does well in the performance-wise, even if it has a higher share that they take for managing it, that's built into the graph. So you see here, way less growth, 2%. But why is that? That's because these companies aren't about major growth. These companies are consistent and they pay a lot of dividends for your gains. But this is going to be taxed as income. So they're going to pay you quarterly primarily. Some pay more than that, some pay less than that. And you will get a dividend from the company. So depending on how many shares you have of that individual company, that's how many dividends you get. A lot of people who are close to retirement like dividends better because it's less risk and they guaranteed income. So it supplements. So let's just say you move all of your portfolio, you have $1 million by the time you retire, you put it all into a dividend fund to be guaranteed dividends. You would get X amount of dividends depending on how much dividends you're getting per stock, per share, and you will be able to live off of that income and keep the rest of your money in investments. So we can look at some of the holdings, like American Company, Cisco, Bristol, Coca-Cola, Pepsi, Chevron, Lockheed Martin, major companies that have been around for hundreds of years. And this is mostly energy, consumer defense, healthcare, industrial. You see how it's very evenly balanced. Next is a total stock market. There's 3,500 in this, so meaning it invests in 3,500 different companies. I'll show you the 1 year is at 16%, so you left your money in, you would have made 16% on top of it. It's free money. The 5-year, you see it's 76%. You see it's a little less growth than QQQ. QQQ has all the same holdings as VTI, but is much more heavy, and you get a lot more of the major technology funds. And you get a lot more growth on growth years. So you see here that that's less than, but just about 20% per year. The other one was, or QQ was 108%. So we see VTI, 34% is basically all the same holdings. And you can take a look at all of the holdings on your own time, but this is good to have a total stock index. You can get any total stock index from any company, it doesn't matter, as long as it's reputable. They're all the same primarily, and they all will be about the same performance. You see technology and financial services and healthcare are the predominant ones. So to summarize, in a portfolio when you're beginning, you're going to want a growth, you're going to want a total, you're going to want a dividend, and probably something else to pair with it for less risks, like emerging stocks, bonds, or whatever else you choose that will be good for you. So we showed QQQ for growth, we showed VWO for emerging, we showed SCHD for dividend, and we showed VTI for the total stock. So let me know what you think. What ETFs are you in for these types of fields, and let me know in the comments.